Hello and welcome to my war and market update for today. First of all, apologies. I promised to do an RBI update before the war and market update, and I did try. I was in the airport between flights, and I recorded with my headphones, and it turned out that the audio was completely inaudible. So the whole set that I had to sit and delete those videos. Anyway, I will cover the RBI policy in today's discussion. So the market was essentially about RBI today. Uh, the RBI policy, let me start off. So, as the consensus was expecting, RBI was hold. Uh, there was a small section of the analysts who were expecting a hawkish tone, and even smaller section who was expecting a rate hike, especially among the international people. Those who were belied, RBI retained a neutral stance. Now, the markets did not jump up and react positively to that flat stance, and I'll explain why to that. But before that, let's look at the data that the RBI threw out. This probably explains the decision making and the reaction of the markets. So the RBI threw out a quarter-wise GDP forecast and a quarter-wise inflation forecast, and it showed that inflation for the year they were up by 50 basis points compared to the previous time that they projected it. The previous year they projected inflation at 4.6%. Now they're projecting at 5.1, and in the third quarter they're expecting it to touch 5.9. Now that's dangerously close to the 6% targeting, and RBI governor himself said that they are 4% plus or minus 2 remains their focus, and they will be ready to act. So to that extent, I think the inflation number the market was unhappy about because it recognized the rise, but it also showed that this 5.9 RBI could easily get it wrong by a little bit, and if it actually comes close to 6, then the chance of an RBI rate hike during the second half of the year step up. So that's one thing which the markets were not so happy about in terms of the situation. The reason RBI maintained a neutral stance was because they didn't hike, because the GDP projections also came through at 6.6%, whereas earlier it was at 6.9. So there's a 30 basis points downgrade of the GDP number in RBI's estimate. And I think that's the reason they retain neutral, because any rate hike could slow down growth further. So RBI decided on the balance that since GDP was also coming down while inflation was going up, that it's better to be neutral. But the situation is that with a neutral stance, they can go either way very quickly. So I think the market probably read into that. And that's why if you saw today, while the market's performance was not bad, uh, but if you look at it compared to a flat rate policy, the rate sensitive should have jumped a lot. Today, most of the indices were just half a percent this way, that way. There were two outliers. The best performing index was the media index. It was again a one stock. I think the Z was up 7%. That's what drove that performance. And on the side, metals and IT. And I'll come to that why in a bit because it's related to currency. So actually, the RBI policy from a monetary interest rate policy was actually a non-event for the market with a slight tinge of negativity. So if you see the advanced decline was more or less equal. 1450 stocks were up and 1600 stocks were down. And the volatility index was actually calmer today. Volatility came down a little bit, not much, but a little bit. And internationally, well, oil continues to hover around the 94, 95 mark. But international markets, Lebanon and Hezbollah and Israel, that doesn't look like this going well. Okay, they are both are sticking to their stance and doesn't look like a ceasefire on that front. Though Mr. Trump is trying his best to do that. So international markets are also deeply in the red as I speak now. So coming back to the RBI policy, then what exactly does the policy do today? The policy focused on another thing which is also hurting inflation, which is the currency depreciation. As you know, Indian currency has been the worst performing among all the currencies in the region. And one of the factors behind that is, of course, FII flows outside, but also the fact is that this currency weakening is making the inflation far worse from an oil or imported gas particular. So to that extent, there was another thing that the RBI was trying to do, which is to, in conjunction with the government, to address the currency situation. Now, RBI again reiterated that they don't target a particular rate. They are more worried about the volatility. But today, the government, by removing taxation on debt-based FII investments, both the capital gains tax as well as the withholding tax, both were removed. So that was a big fillip, and RBI followed up on that with expanding the number of G-Secs that they can. Earlier it was restricted to 10-year G-Secs. Now they made it to 20, 30 and 40 also. They widened the basket, and in the short term they've done away with the limits. Other than that, for the currency, they also have allowed NRIs and OCIs to invest a greater amount in Indian equities. There's a small thing for equities. And so most of the actions, in fact, they allowed the continuance of the swap for public sector banks on the forex side, and they allowed the public sector enterprises also to raise ECB loans in a more relaxed manner. So all of these were intended to help currency to come in. So I think the currency market reacted very positively. The rupee was, I think, up almost 90 paise, improved by almost 90 paise, and breached through the 95 barrier to end at around 95.89 or thereabouts, right? The bond markets, naturally, with the expected inflow in G6, also reacted positively. And initially, there was about a 10 basis points drop in interest rates. It finally settled at about 6.96. And I think yesterday was 7.03. So it's about 7 basis points easier, right? So effectively, the policy today impacted the currency and the bond markets, did not impact the equity markets, but there was a tinge of negativity because the door is open now based on how the monsoon's deficiency progresses, based on how the war progresses, that there could be a rate hike factoring in the second half of the year, right? So that was the summary, and effectively it explains the market also today from that point of view. But for tomorrow, rather Monday, we'll have to wait for the long weekend, and not long weekend, just the next 48 hours. But as things stand, the GIFT Nifty is in a negative territory because of the fact that Lebanon, Hezbollah, and Israel have not been able to come to terms on holding fire, right? So thank you, and once again, apologies for the goof up on the RBI policy update, which I have hopefully covered here, and look forward to my weekly update on Sunday night or Monday morning.